oil has been struggling, stuck below $70 US a barrel this week. Investors, traders are worried about the potential for an oil market glut. Let's get more perspective on the energy markets. We are joined by Bob McNally, president of Rapidan Energy Group. Bob, thanks very much for coming on the show.
Thank you for having me, Andrew.
Looking at the world oil market, inventories are not that high, it seems, but the market seems pessimistic.
No, you're right. Inventories in the OECD are below the 5-year average, especially for crude. This is not a sloppy, oversupplied market yet. But, you know, as you pointed out, the sentiment, the belief, and we share it to some degree, is that as we look ahead, oil markets are looking to be oversupplied, not only in 2025, but even in the years after that. That's because supply in your country, Canada, my country, the United States, Brazil, is rising faster than folks thought. And so prices discount the future, as well as sort of reflect current fundamentals. And I think the market is looking ahead and seeing soggier fundamentals than if we were to look out the window right now.
You mean weather-wise?
Yeah, well, soggy, oversupplied, right. That we have, you know, it's not about peak demand. It's not about demand slowing structurally because of EVs and things. There is weakness because of macroeconomic weakness, especially in China. But it's just, you know, we're seeing those animal spirits return to those producers in Canada, Brazil, United States, other places where efficiency gains are churning out more barrels per rig. And that's starting to catch up and even overtake demand growth.
Who could increase their production? You argue that America is not in a position to jack up output in the near term. It's near capacity. I mean, obviously, over a longer period it can. But OPEC Plus does have enormous idle production.
They do. You're right. You know, the only countries that can quickly increase crude oil production are those that hold spare capacity. And that's primarily Saudi Arabia, UAE, a little bit in Iraq, Kuwait, et cetera. But it's mainly in Saudi Arabia. You know, you just can't turn on the taps. Our industry, your industry, they operate at full, you know, max capacity all the time. And so that power to unleash oil in the near term resides in OPEC Plus.
Turn to Iran, if you would. President-elect Trump has made it clear that he's not happy with the deal that the Biden administration reached with the Iranians. He previously canceled the earlier, I should have said the Obama agreement. He canceled that deal. But the Biden administration has arguably turned a blind eye to Iranian oil exports. Will President Trump, when he takes office, crack down on those Iranian crude sales?
We think he will, and we've been telling clients that for many months. I think only since the president's election have more market participants and the press begun to focus on that. The Trump team regards the first term's Iran sanctions as a great success. They drove Iranian oil exports down to a few 100,000 barrels a day. They thought it was quite successful. And there's even more concern now that Iran is using that 1.5 million barrels a day of oil exports, the revenue from that, to not only sow mischief and attack Israel and U.S. interests in the Middle East, but also to support Russia in its war against Ukraine. So they are more determined than ever to re-exert that pressure on Iran, leverage Iran into a deal. But let me say, I don't think President Trump wants a war, per se. I think President Trump wants to restore leverage so that he can get to a deal with Iran. But that is coming. That is certainly coming. And let me just go back to, Andrew, what we were just talking about with regard to soggy or oversupplied fundamentals. You know, removing 500,000 barrels a day or 1 million barrels a day of Iranian supply next year could be just what the doctor ordered in terms of preventing that oversupply and lower prices, because the first casualty of lower prices would be U.S. shale production.
Because you argue that they're high cost.
They are. It's shale operations, break-evens are in your $50 range, and the decline rates are high. So when you stop hydraulic fracturing operations, you start to see decline show up very fast in the United States. We're the first casualty if oil prices go down.
Mr. Trump, I mean, people say all kinds of things on the election trail, but he said, "I want massive U.S. production, but I also want low oil prices." So, I guess the two go together. I mean, he did say that he doesn't mind if the oil, if I remember rightly, he doesn't mind if the oil industry drills itself out of business. He wants to see extra U.S. output.
Well, that's the dream, of course. We want to have ample U.S. production, robust U.S. production, and we are the world's leader at 13.4 million barrels a day of crude in September. But we also want to have low prices. Now, the problem is one contradicts the other. If prices for oil fall much further than where they are, if we go down, some have spoken of a halving in crude oil prices. If we go to $40 or $35 a barrel, we're going to see shale oil production screech to a halt in terms of growth, flatline, and even start to decline. Andrew, President Trump learned that lesson in the second quarter of 2020. When OPEC Plus got into a fight during COVID, they went to max production, and crude oil prices collapsed. Now, the first $10 or $20 are enjoyable because everyone in our northern hemisphere gets a tax cut. But when you start to get to $30, $20, $10 a barrel, you start to destroy the U.S. shale sector. And back then, Andrew, you'll recall, President Trump sort of put aside decades of loathing of OPEC and actually organized an OPEC Plus deal and got them to cut production and rescue the shale industry in the middle of 2020.
Broadly speaking, what is Saudi Arabia's game plan right now? They are leaving money on the table with their big cuts and the low prices they're getting for oil.
Well, Saudi Arabia, as the leading swing producer and supply manager, has the same core concern the United States did when we did this for 4 decades. Stability, stability, stability. Saudi Arabia wants to prevent inventories from getting wildly out of whack. Too high and prices collapse, too low and they skyrocket, and you get into these boom-bust price cycles. They don't want that. So I think the Saudis, they don't have a price target. I think they are looking at inventories and they're trying to calibrate how much supply they return to the market with their allies in OPEC Plus so as to not cause wild inventory imbalances. It's a tough decision, a tough thing to do, but they're doing it. They're showing restraint. They delayed their tapering. We'll see what they do on December 1st, but that remains their goal. Stability, stability, stability.
And leave us with a final thought. Russia's oil is still making its way onto world markets, albeit at a discounted price. What will happen under a Trump White House? I guess it's impossible to predict, but would he be inclined at all to increase sanctions on Vladimir Putin?
I think he would, and that's a surprise. Most people think that Trump is going to come into office and call up Putin, and there'll be a love fest and so forth. We don't think so. Just as with Iran, President Trump will want to get leverage on Vladimir Putin in order to get both Ukrainians and the Russians to a deal. So, especially if the oil market is oversupplied and shale oil and the United States is at risk, I think he'll be even more willing to look at sanctioning Russian crude oil exports, even Russian LNG exports. Yeah, that'll be a bit of a surprise. We don't buy this love fest with Putin, not in the beginning anyway.